So as we all know, the Jibar transition represents a significant change in the South African business landscape, as well as financial institutions will need to consider its implications for the strategic management of their respective balance sheets. So we have today Bhulesh Singh from First Rand, as well as Richard Klotnik from APSA, who will be taking us through a presentation on managing interest rates and liquidity risks during the Jibar transition. So just a brief overview on these two gentlemen. They have a combined 36 years worth of experience with global financial markets. Bhulesh is the group treasurer for First Rand, for embedding broader impact outcomes and externalities into First Rand's financial resource pricing, while Richard currently serves as the interim group treasurer at APSA Group and is currently the chair of the MPG derivatives workstream and has been tasked with supporting the transition of the derivatives market to Zeronia. So over to you, gentlemen.
They're just giving you a mic for questions. Are we on? Okay, great. Okay, good afternoon. Okay, let's go. Okay, this is just the introduction. Okay, so I thought I would cover, I guess, maybe a different perspective to some of the intricate detail you I'm sure there's more intricate details still to come, but I just wanted to give a different perspective because if the point is how we manage interest rate risk and liquidity risk through a transition, we actually have bigger problems. So we've got bigger problems to manage, and hopefully we can cover that. And the Zeronia transition or transition away from Jibar for us is a basis risk, and we'll come to it. And it's part of the process, but shouldn't detract from our core functions of managing interest rates and liquidity risk effectively in a balance sheet. So what does like ALM look like at a balance sheet level? So what I've done is, this is a stylized view, is to try and give you some perspective of how a treasury would look at a balance sheet at an aggregate level. And there's different dimensions or different lenses with which you can look at this. So this is what I'm trying to show. So of course, there's the interest rate duration, which is one lens. There's a liquidity duration, and that liquidity duration, as all our ALM experts will know, there's actual, contractual, there's behavioral. There's all of these different perspectives we will take. And I think the point is that in a treasury, you kind of have to be able to move between these and understand what assumptions you make when you move between these. So that's another important point. And the other here is that actually, if you just look at a bank's balance sheet, the amount of the exposure that's actually still linked to overnight is quite important, right? So if you think of the typical bank's balance sheets, so bank's balance sheets around 6.5 trillion rand, I think, in SA at the moment. Loan books are significant. In the loan books, the residential mortgages are one of the most significant asset class, all overnight linked. If you think about the SA banking system, it's probably between 60 and 70%, I would guess, deposit funded, all overnight linked. So you're actually talking about an overnight linked system with very high rate pass-through, in our view. And then on top of it, we've then got some of this Jibar risk to deal with. And so, I mean, I'll cover it as we step through it, but effectively what I'm saying is that, certainly from our perspective, the Jibar resets was actually a major inconvenience. So to have a system moving to more overnight linked is actually substantially beneficial from an efficiency perspective, and I'll just explain a little bit about that. Let's just move next. Just a bit more. Sound again? No, it's fine. Just to give some perspective again in terms of context. So, like I said, so bank's balance sheet, 6.5 trillion, which is then sixfold that. So every basis point on a trillion is 100 million rand. That's kind of the volatility we then experience from Jibar risk at the moment in terms of resets, fixing, and the like. And again, this is just to give you that kind of perspective on the scale So, like I've said, tried to explain, is that for us, the overnight rate is more natural, actually, for us. All of our deposit products price on overnight or overnight referenced. Loan products are prime linked often, or which are referenced actually back to the repo rate. And like I said, the 3-month fixing is usually just an inconvenience when you're trying to manage fixed rate risk or term fixed rate risk. So yeah, so that's just a bit of perspective on that. And I think ultimately, from our perspective, what we think is that you can change the reference rate. It can be anything. You can make it repo plus 50. You can make it anything you like. Ultimately, still, you will have market forces that have to come to bear to actually clear the demand and supply. So I think we'll come back just now. Okay, so again, just a bit of a perspective on how a bank or a bank treasury thinks about ALM risks. And in this part in particular is about the management of structural interest rate risk. So as I explained in the opening slide, which showed the different durations that you would look at, so interest rate duration, behavioral duration, liquidity duration. When you choose now to act or do something in interest rates, as soon as you move away from overnight, you've got mark-to-market risk. So on overnight, you've got other risks, but which is actually earnings volatility. So if you overnight, you've got maximum earnings volatility. The further out you go, you take away your earnings volatility, but now you increase your mark-to-market risk, which then can still manifest in earnings volatility, but a different channel. So when we think about this, what we're saying is that you would need to take an integrated approach when you look at this, which would look at what is your capacity for earnings volatility? What are you actually trying to solve? What are you trying to protect against? What are the pain points for you at the moment that you're actually trying to address? You will then look at NAV volatility, so that's the net asset value volatility. So this again in a banking context, it also then depends on your various accounting practices and the like. So if you were to employ hedge accounting methodologies or cash flow hedge accounting, that volatility goes through your NAV. So you must have some capacity or appetite for NAV volatility. So you have to choose that. That's a conscious decision. Then what is your risk capacity and then risk appetite? So again, those are two different things, capacity and then your appetite within that capacity. Also important. So what is, depending again on the scale of your activities or the scale of your investment activities relative to your NAV, etc. What is your capacity and appetite in there? Then there's opportunity cost. So opportunity cost is there's different terms for this. We call it the hindsight traders. So the hindsight traders always come to you with opportunity cost. Or you could have done this, you could have done this, you could have done that, you could have done it, you could have waited, you could have done a lot of things. But you have to consider opportunity cost in the decisions you make. Because there will always be those hindsight traders. So I think you must have some appetite for, regardless of what happens, how comfortable are you with your investment process, the decision you're making on interest rate risk? Then there's EVE, which is actually for the bank treasuries, they'll know this stuff. It's the enterprise value at risk or enterprise value sensitivity. There's different kind of acronyms and international and local literature on it. So that's effectively the mark-to-market of the bank's NAV for the interest rate risk it runs under a prescribed scenario. So the scenario we have for RAND rates is 400 basis point stress up or down. What is the fair value impact into your NAV? So that's EVE. And then, like I said, I suppose I've covered it already, risk appetite. So point being, in your thinking on how you manage structural interest rate risk, one would have to consider all of these things and then make a conscious decision about how you want to move forward. So just quickly, again, in terms of the yield curve moves now and managing structural interest rate risk. So South Africa experiences some significant moves in our curves, as I'm sure you all are aware of. So this is just comparing May to August, so 3 months apart, and the impact in terms of the level of rates. So again, from a treasury management perspective, these are far more profound moves than a few basis points on a reset risk. Okay, so these are the things that we're actually managing from our perspective. But further, it's important to understand when managing these risks, what's actually driving these risks. So what's driving the level, the structure of risk premia. So if the structure of risk premia is from credit risk, if it's from liquidity risk, if it's from sovereign risk or inflation risk, so now I also we must also acknowledge that decomposing these spreads is extremely difficult. And there's enormous technical research on how to decompose these things. None, in my view, are perfect, but you can still have a useful understanding of the attribution of the different risk premia to what aspect. And these are some of the things, again, as a bank treasury, that we are concerned about in terms of managing. So here we just show quickly the bond curve move and the FRA curve move to give a more shorter term perspective. Sorry, I know the scales are different, so the move is not quite as big, but it's still significant and shows that these rate moves are actually the business of structural interest rate risk management. And then they're not necessarily just the Jibar or Zoronia basis. Okay. So this point, okay, so I know it goes back quite a long while. So it goes back to 2001, which incorporates some significant stresses. So 01, 02, and 08, of course, and the COVID stress. But this comes back to the point for us, which was just the history of Jibar and its use. And in our view, or my views, I should say, it's an unrewarded risk in the sense that it's an estimate of something, but its volatility was not worth it. So it introduced a lot of volatility as opposed to help you manage or mitigate volatility. So again, this is why I've said kind of repeatedly that for us to have Jibar risk removed is actually a very positive development from an interest rate risk management perspective. I mean, if you look at just to quote the one number, so the standard deviation of Jibar versus the mean is a 7-fold. So in most things, if you want to invest, if anyone does any portfolio analysis, if your volatility is 7-fold the mean, you don't do anything. So that is that back? Okay, there we go. Okay. Okay, so this is just to try and, again, okay, it's got a bit squished, I think, but anyway, again, just to try and point out, in the management of liquidity risk, banks are still intermediaries. We still transmit liquidity conditions, we transmit interest rate conditions, we transmit cost of capital across the financial system. So obviously between the central bank and the banks is liquidity transmission, payments, and monetary policy transmission. And then thereafter, the banks transmit that into the broader financial system, as well as transmit the clearing prices of savings. So hypothetically, let's just say that no one likes, you transition from a Jibar to a Zoronia rate, but the 12-month NCD, for argument's sake, will still trade at competitive forces determine it to be. What banks then choose to do with it and how they choose to manage that interest rate risk is then separate. You could not hedge it, or you could hedge it. And I guess my point being that the transition to Zoronia does not disrupt the fundamental economic forces that apply to the financial system. So that's just my perspective. Okay, so just quickly again, so Zoronia is the basis risk. So what's kind of our approach to managing this? So I think what we have done, so we've got an extensive project team across the various divisions and the various areas. We've also got, and that project team is then managing it. I'll cover in a summary just now, but they also have to consider I mean, a lot of this work is operational in nature to help with the remediation and the transition. So we've started the process of now people are going through legal agreements and going through deals and going through everything to understand what deals have got fallback language, what deals don't, to start categorizing those, what will automatically have transition, what we're going to have to remediate, what are problem loans. I mean, I think, for example, I don't know if I'm allowed to quote it, but we've got one deal that still hasn't transitioned from LIBOR, which I'm sure is a problem. I'm sure it's almost illegal, but the person refuses to do it. So you're going to get these things come at you from somewhere. So we need to kind of prepare and start. So we have to understand. I suppose the one point is that maybe not everyone has, or particularly the investment industry, but the banking industry has had several dry runs with the LIBOR transition, both for sterling, SONIA, as well as for dollars, for SOFA. So we've kind of had to go through this process. So for us, it's a gain. Obviously, the volume is a whole lot more, being a Rand bank. I'm sure you would have covered this earlier, but I just wanted to make the point about the mismatches here. So for us, when we look across the different conventions and where they is about where there's alignment, because this is now where you can get other basis risks or mismatch risks. And there are some minor ones between, but I think, again, the important point being here is that it's still so much actually improved relative to the Jibar risk that one would have had. And even if you are in the bond market and you've issued a bond, you can always trade a 5-day lagged resetting swap if you wanted to. I mean, those things will exist. It just won't be the standard instrument. So you can still get the cash flow matching or the rate matching that you're looking for if need be. Just, I think, second last slide is just on, just to mention the work. I think there's still work being done on the CAS spread. I'm sure some of the working group participants are here. I'm not in there, but it's fine. I'm very happy that someone's doing all the work to help us. So I think just important points. So Zoronia is going to be lower than Jibar, and that's not. It's not because someone's trying to do something untoward. I think it's because it's just how the rate is manifests. I think it's important to note. So Jibar is a term rate. It's a mid rate, which are important. And in that term rate, there's liquidity components. In theory, there should have been credit components as well, but I don't think it's really that. It's more other kind of factors. And there's another factor of the price one must be rewarded for to be locked into a rate. So which is this term premium, I guess. And then so we think that the credit adjustment spread is intended to ensure economic equivalence, and I'm sure the process will proceed, and there'll be a very robust backtesting process and a very credible process for it. So we look forward to that as well. So just in summary, I think we must also reflect on why we've got here. So we've got here because there were flaws in the way LIBOR was constructed, LIBOR was used. Then the world, G20, IOSCO, came up with standards about why we must transition and replace these important reference rates that play such an important role in financial markets. So I think there's improved integrity with this process, much better transparency, efficacy, and appropriateness. We think the institutional fund market will adapt quickly, more from a pricing perspective. I know I'll cover it in the last point. There is still a look-back period basis on the bond market versus cash and derivative market, but we think it's still significantly improved. And this is the last point about actually the challenges remain, which are still significantly operational in nature. there's actually enormous amount of work to do that's happening inside of all of the financial institutions. I've mentioned just a few things, and this is not exhaustive. It's the full rebuild of a whole lot of curves, all of our spread curves, basis curves, VAR models, valuation models. All of these things have to be rebuilt. Almost every system that manages accruals, resets, or intersettlements has to be touched, either modified or adapted in some way. Every single thing. It is a profound change from a work perspective, which I think is important. So we must, I think, acknowledge all that the people that are going to be helping us do this in the technology space, valuation spaces, legal, with institutions. So all agreements require remediation. Hedge accounting is another one where various hedge accounting models have to be rebuilt. I'm excited about that one, not for the people who have to do the rebuilding, but because we get rid of an additional ineffectiveness component, which came from the Jibar rate reset. So to have that taken out means that actually your hedge effectiveness should improve, and then hopefully less volatility, and then the accountants will be less upset with me, and it will also be much more efficient that way. So I think that's all from me. I'll hand over to Richard. Thanks.
Good afternoon, everybody. I think the previous panel and Parin was very brave eating into lunchtime. I'm not going to be as brave and take more than I should. So I may skip over a few points, but I think they've been well addressed. And but I think everything that Balesh has mentioned, I certainly agree with. I think from a bank perspective, where we are in a fortunate position is that we've already had the LIBOR transition. So we've got a bit of a taste of what it takes to transition from one to another. And so it's given us the opportunity to look at how did that project go, what was done, and how do we use those lessons going forward in terms of transitioning to Zeronia. In terms of managing interest rate risk, Balesh alluded to it, and just check that this works. Give me a second. There we go. The biggest risks in this regard is the basis risk when it comes to the change to Zeronia. But this is not a new risk for banks. We've had prime Jibar, we've had bond swap basis. So this is just going to add a new dimension to all the basis risks that we have to manage. And I think the second point there is, as Balesh said, is this helps us going forward, right? Where we've got overnight loans, home loans to retail investors. Anytime there's an interest rate change, immediately that loan changes. As if you have funded that loan via a deposit from an asset manager on a Jibar basis, that interest rate will only reset over the next 3 months. Whereas going forward, we're going to have that same loan being Zeronia linked, resetting every day to match that prime linked home loan. And so this is going to be a big positive for us, as Balesh alluded to. There are some institutions, though, banks, non-bank financial institutions, where this is going to be a bit more difficult. And it comes down to the fact of what loans have been given to retail investors linked to Jibar. Now, if they're short-term loans, it's not a problem because we've got some time now. Let those loans mature, and then you can start a new loan linked to Zeronia. But what happens if you've got a 5 or a 10-year loan? What happens if you've got a 15-year home loan that's given out to a retail client linked to Jibar? Now what? It's all good and well in the where you've got more sophisticated investors, more sophisticated clients where you can have this discussion with. How do you have this debate with thousands and thousands of retail customers? And so this is a key challenge that those institutions are going to have to face, and the industry is going to have to face. It's going to entail engagement with clients, fallback language, tough legacy, as we've mentioned, but it becomes more difficult when you're dealing with retail investors. The next point with regards to how do we as a bank or how do we as a treasury think about some of the other impacts is, remember, on every day we are taking in funding and we're giving out funding to go and do loans and go and grow the asset side of the balance sheet. And based on the cost of funding determines the cost of the funds that get given to the businesses that write these loans. So now we've been doing that off a Jibar curve. And generally as a bank, and I think there's quite a few other banks out there, is we generally swap all our fixed rate risk into floating rate. Okay, and that's the interest rate risk management. Now we're going to have to think about it very differently. We're going to have to swap all the fixed rate risk into Zeronia. Okay, but now we've got this funds transfer pricing. One's linked to Jibar, one's going to be linked to Zeronia, and you're going to have this mix of different types of funding. So some of the things we're thinking about in terms of trying to support this initiative of getting liquidity going as quickly as possible is, is there an element that we can maybe incentivize our asset business or incentivize corporate clients to say, if you come to the bank and you want to take a loan, the loan is going to be linked to Jibar, or you want it linked to Jibar, we'll say, okay, we'll actually sweeten the deal by X basis points if you do it linked to Zeronia. And by that way, we start to get the industry moving much closer to Zeronia pricing. I think the CAS fallback methodology we've spoken about, basis swap liquidity is going to be another one. During this transition period, we're going to have Jibar, Zeronia, like I've mentioned. But I think as a financial industry, we need the ability to start hedging out between the different risks. So to go and get rid of our Jibar risk and rather be exposed to Zeronia. And I think this is the critical risk, and we've highlighted it this morning, and I mentioned it this morning, is the biggest risk here is liquidity in the market and the volumes. Banks, NBFIs have a considerable amount of Jibar-linked liabilities or exposures to be hedged into Zeronia over the next 2 years, and this is critical. Then maybe just to spend a little bit of time on liquidity and funding considerations. When we think about the transition timeline, and I think Ajay alluded to this a little bit earlier, we have moved the cross-currency basis market in terms of timeline and thinking to transition. We've moved that to the end. Why? Because the cross-currency basis market, the cross-currency market, is used as a funding tool for many of the banks, as well as in many of the corporate funding deals that go on. And so it's critical that by that stage, there is sufficient liquidity in the market to ensure that that cross-currency funding market operates very well. And so just for some of those of you who may not be close to this, banks can either, instead of going and raising dollars for a dollar loan, we can go and take rands, put it down into this cross-currency market, get dollars, and use that to fund the loan. And that is used extensively throughout the financial industry. And it's important that fallback language, CAS spreads, all of that starts to get built in into all of these trades. And I just want to reiterate the point is that this isn't a banking problem. This is a sector-wide problem. And any corporate, especially those sophisticated corporates, who look at the basis market and say, where is it cheaper for me to fund? If you do have loans linked to the basis market, this is going to be relevant to you. Obviously, within the South African banking sector and many sectors around the world, there's a heavy reliance on the wholesale funding market. So at any one point, the market in South Africa borrows hundreds and hundreds of billions of rands of funding from the investor market. And it's critical that they are ready for this Zeronia transition. And some of the discussions we've had over lunch and during the coffee break this morning is the sense we're getting is a lot of the big asset managers, they're going to be ready. They're going to be on board. They've got the ability to absorb those costs. What about the smaller asset managers? What about the smaller insurance companies? What about the smaller corporates who are going to have to take on this cost? We spoke about legal fees, but there's operational costs, etc. And these are some of the concerns we've got because when you put all of these numbers together, they still contribute a fair amount of funding into the market. The last point maybe to mention is any entity who has traded a derivative with one of the banks will know that if there's a significant move in market pricing, you're going to get margin calls, you're going to get collateral calls. All of that, as we said this morning, was priced off Jibar. Now we're going to have to think about how do these posting requirements work in a Zeronia world. A lot has been said, I think, about the operational changes that are required. They're massive. I've just highlighted a few here, but I think the heading says it all is, well, what is changing? And the bottom line is a lot. Whatever's being done at an industry level effectively is being done at each bank, each financial institution, every corporate, every non-bank financial institution, maybe to a different degree, but it touches on every part of the organization. I think the other key point here is, well, how do we think about this from a risk perspective? And an institution needs to apply its risk appetite approach, its risk taxonomy, its organization, to this Jibar transition process. We need to ensure adequate reporting to board and risk committees, and it's going to be these committees that need to ensure ultimately that whatever is done via the business lines, etc., that there's adequate leadership, planning, project management, etc., to get this transition across the line. Then turning to risk management, and some of this has been spoken to, but internally from a bank perspective, you can imagine the amount of model risk, model valuations, risk management that gets done based on all these models. And running valuations currently using a Jibar curve, we're now going to have to think about it with an additional curve. And that in and of itself brings some challenges. And why do I say that is when you look at what's happened globally, when the US, when the UK, even ourselves, when we started to introduce this new benchmark. So when you look at the very first few days of Zeronia, you can see the volatility in the index was a lot higher than what it should have been. Now, you're looking at, you're taking this historical data, putting it into your VAR models as an example, and you've only now got 5 years worth of historical data. That's a challenge in and of itself. Currently, we're putting 20 years, I don't know what the exact number is, of data into these VAR models. You're now going to have this concentration or this exposure being much more focused on short-term experience of what's happened to Zeronia. And I think this is something that regulators across the world have considered. The Bank of England, for example, gave some dispensation to banks in terms of how they think about their VAR models. So maybe last slide, and then we can save some time for questions, is regulatory reporting and accounting. I think Bilesh spoke about hedge accounting. And, again, I think globally we've seen the regulators taking a very pragmatic approach here, where banks would, and some corporates would apply hedge accounting. Your hedge becomes effective. All of a sudden, when you change your benchmark, it can become ineffective. But what we've seen globally is there hasn't been a requirement for banks or corporates to go and unwind that hedge because it's become ineffective. In terms of regulatory reporting, I think there's two key points that we need to consider here. We spoke earlier this morning of how do we encourage the system to move quickly to adopt Zeronia as quick as possible. And there's a soft element and a soft pressure that ultimately comes from the regulators, from some of the other regulatory bodies, etc., in terms of the monitoring of bank positions. And this is already commenced. So on a quarterly basis, I think it is, all the banks in South Africa are already supplying the entire suite of data of what does our entire Jibar book look like. And I think the questions need to be asked going forward. Once we get to the point of decision, the question needs to be asked of banks and financial institutions, if the exposures to Jibar are climbing, why is that the case? They should be falling, and that should be done to support the industry. Then lastly, obviously, from a regulatory reporting perspective, all the BA returns, all the regulatory returns that we as an industry, and I think the insurance industry as well, have been set up years ago, right? And they reference Jibar. We now need to think about updating all of those returns to reflect the concept of Zeronia. So I think when you think about what Bulesh said, you add some of these points, I think you get the message that such a change like this is massive for the financial sector, for the banking industry, and it's not an option to get it wrong. We need to be very clear in terms of timelines. We need to have consistency in terms of those timelines, but we also need to have buy-in from all market participants because we are ultimately all in this together. So it implies the need for a liquid and deep Zeronia derivative market, because the more liquidity there is, the greater the ability is to hedge risks, to switch over and move forward as an industry overall. So I'll stop there, and we're happy to take questions. Thanks.
Thank you very much, Bulesh and Richard. Richard, I'm quite happy that you mentioned the FTP there on your slide. Maybe what you haven't shared, and maybe if you have a word on it, is on the LCR and NSFR. We know that the transition will definitely affect the cash flow timing from a liability perspective, so the cash outflows, and possibly also on the asset side. So how is the banking sector then preparing for the impact on the LCR and the NSFR? So that's the first question. The second question, I think in your slide there, you said that the lack of liquidity in early days require conversation. So we know that when we speak about liquidity, there are three types of liquidity. So there's market liquidity, funding liquidity, and central bank liquidity. So the question here is there an expectation from a central bank perspective, from a central bank liquidity perspective that has not been articulated yet? So those are my two questions. Thank you.
Okay, this is working. So from our perspective, I don't expect any impact to LCR or NSFR at all from the change, other than if from a second round perspective, it impacts asset manager appetite. So just the technical change itself should have no impact from our perspective. Then in terms of the different components of liquidity, it's actually market liquidity that would be of a concern. So some, not everyone, some people may know about this RODS market that we had once upon a time. But similarly, lack of liquidity and for liquidity, that's a whole nother talk about the dimensions you need to support true market liquidity, different perspectives, different appetite, different needs, because a market by nature has to match something. So if everyone wants the same thing, you can't match to something effectively. So there's other forces in terms of developing market liquidity, but from our perspective, with regards to Zeronia and a liquid Zeronia swap market, it's purely a market liquidity development that's required.
Not much to add. I'd just say, in terms of LCR and NSFR, we have looked at its impacts, very small. But from a liquidity perspective, I think we will allow the time for that to build. And in terms of the central bank and the expectation there, I think it's very limited from our perspective. Where there might be potential is if there's offshore dollar bonds, etc., and looking to hedge those if that is the case. Just to put pressure on those liquidity providers, whether they be local or internationals, and maybe even the internationals in particular, because the locals we can see are doing the test trades, we're on board, there's this big push. Some of the internationals are taking a much more wait-and-see approach, and ultimately are only going to face this dilemma when there is a cessation in Jibar. And so I think whether it be the central bank or any of the other institutions asking for those derivative transactions linked to Zeronia can only help in that regard. Any other questions? At the back, go for it.
Thank you, Peter and Bulesh. I hope you can hear me clearly.
Yeah, we can hear you.
Might be a bit of an unfair question, a bit of a chicken.
In that case, Balesh can take it.
I was about to suggest the same thing. Both of you alluded to basis risk between Zaronia and Jibar, and we know that's not a market that currently exists. But both as treasurers, you mentioned that that's critical in managing the risk. If we just think of Zaronia first, what would you say is the most critical? Do you think basis risk is critical as we think about Zaronia first derivatives? Or do you think that that risk as treasurers you are comfortable with managing naturally as you would with Jibar versus 3-month Jibar versus prime risk, which is the natural basis risk for all banks in South Africa? Mostly.
Happy to start. Look, I think from our perspective, if the derivative market is up and running and there's liquidity there, I think automatically that's going to spill over, into the basis market. As we both highlighted, we've certainly got an incentive as a banking sector overall to move as quickly as possible to Zaronia to match your asset and liability side. And so I think you will see I'm speculating, but Balesh, maybe you can correct me if I'm wrong, but I think you will see an active participation from the bank treasuries in that basis market once the derivative market is up and running. Because, as I say, it suits us. It's the right way for us. And, once you've got the derivatives to back out that risk, it certainly makes it a lot easier. So in terms of Zaronia first, I don't think that is the critical part. I think the critical part is the derivative and cash market, because, ultimately that's going to give you a hedge. In the cash market, every time we issue fixed rate and want to hedge it into floating, we'll then go put that into Zaronia, and both sides of the trade are going to give you some liquidity in the market.
Thanks. I suppose the only thing to add is there's a Zaronia market in its infancy, so people are quoting Zaronia swaps. LCH, I think, has gone live on Zaronia swaps. And we have a prime market. So when you combine the two, you almost have an implied basis market. So that kind of already exists. I doubt it's liquid at all. But from our perspective, I think it's, as we evolve through this, I think having access to a deep cash market actually means that managing the Zaronia risk becomes a natural evolution for us. So we'll probably get some surprises, just because it's always the case, but we're not anticipating one.
Thank you. I suppose the other risk that I think as treasurers we probably need to consider is the systematic risk that could be introduced. So to the extent that you're expecting that hedge on basis risk to be off-taken by another local bank, which I doubt, I'm not sure whether international banks will be looking to do that, then that risk just ends up recycling itself through the banking market as well. And we really haven't achieved much as a bank, as a banking industry.
Yeah, so maybe I can answer just philosophically on that, I think. Is that, so firstly, we make, or this is maybe very specific to us, is that we do things not with the anticipation that you have to hedge it in all instances. So there are things that you can do where you are comfortable to assume that in terms of your structural risk position and your structural risk capacity. So I don't, from a rate perspective, expect systemic risk, if that makes sense.
So I'd agree with Balesh and say, look, you're not forced to, but I think your question is relevant, and that is why I alluded to the fact around the offshore market. When you break down the volumes of the South African derivative market, we can clearly see the dominance of offshore market makers, offshore traders. And I think there's a huge amount of rate risk that gets hedged out into the international community. And so I think where this point is relevant is when potentially you have both markets running concurrently. You have Jibar, Zironia trading during this transition period, and potentially you don't have that offshore market adopting Zironia as quickly as possible. Then you could find that local banks, local traders, are sitting with a lot more Zironia risk than what they would want to normally. And that's why I think all the efforts that some of the sub-working groups, I think on the derivative work stream, have been really pushing the internationals to get on board, to get them ready, and to be able to trade as quickly as possible so that we don't face that.
So the question, well, you've raised the point of how a change in the interest rate metrics has got an implication for the plumbing and operational. But you've raised an interesting point because you were referring to the 5-day look back in bonds and loans versus 1-day look back in money market. You suddenly become aware that sometimes the infrastructure or the plumbing is creating interest rate risk. So shouldn't we rather at the same time be changing from a 5-day well, it's actually a 5-day X period, but changing our X period? It seems like we're a bit of an outlier, not, with that 5-day period. If it's creating this kind of interest rate risk or this basis risk, we should be thinking about these matters. I think we've suddenly become aware of the power of overnight. So, yeah, I'd be interested in your thoughts on that. And also T, settlement. Internationally, everyone's going to T+1. Immediacy actually reduces a lot of risks that we currently face in the market. So I'd just be interested in your thoughts on that.
Yeah, Joe, when you asked the question, I was smirking a little bit because having been involved in derivative and cash workstream, that conversation certainly came up. And I can see a few nodding heads here. There were reasons given why it had to be 5 days, 2 days, 1 day, etc. But I agree with you. I think to an extent it is unfortunate that it didn't align. I think we've gone maybe a bit too far to walk that back, but happy to be challenged on that in the audience and hear other thoughts. But, I think Balesh said that risk ultimately is going to be quite small relative to the Jibar risk we're running already.
Sounds like another working group.
Yeah, Joel wants to head up that working group. Great. I think we're out of time, but thank you, everybody.